Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Things often move very quickly in the Australian share market, especially when the CEO and director of a company is Richard White of WiseTech. If you've been following this story, you'll know that things have moved very quickly. This episode was recorded prior to Richard White stepping down as WiseTech director and CEO. Now, we're not sure if this is going to make any material difference to the outlook for this company, but it doesn't change the numbers that we talk about in this episode. So keep in mind this was recorded prior to the resignation and stepping down as CEO and director of Richard White. Thank you.
Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking at WiseTech Global, ASX code WTC. This is about the billionaire from Bexley. Where do we start?
That is, there are so many places to start, and thanks very much for having me on, Phil. But obviously, we're going to talk about a company which has commanded a hell of a lot of the headlines in recent times, particularly in the Sydney press, a town you would know very well in your past life. And obviously, we need to try to dissect what's occurring on the front pages versus what's actually occurring within the business, which are two very different things, which I'm sure come as no surprise to anyone.
Is this a classic case of key man risk, Elio?
It's very hard to dissect the two. I mean, obviously, we're talking about Richard White, who started the business, effectively grew it to what is now a multi-billion-dollar company. And obviously, there's one argument which suggests that you can't separate the two, that ultimately his own personal journey will be linked to the business. And let's face it, we've had recent examples of that in the past, which obviously are well documented and well highlighted. But then there's the other, which is CargoWise, which is ultimately their technology that they sell out to all the various distributors and shipping companies. The question is really, did that become the multi-billion-dollar business just because of Richard White? I mean, he still has a 40% interest in the company, don't get me wrong, a little bit less, obviously, following the recent sell-downs. But I think it's important to remember that whilst, yes, the founder is important, and there's something called the founder effect, which is, obviously industry knowledge, drive, wanting to succeed, et cetera, all those things. There is a point where that does start to diminish in regards to their impact. And often the thing that determines success or failure is that founder's ability to step aside and really let the boffins, as it were, take control rather than necessarily drive a very tight ship themselves. This is a company which has had a pretty aggressive growth strategy in recent times. I mean, they've made no secret in regards to their intention of wanting to effectively command the entire logistics space. And ultimately, that is what they've gone about doing. But blow me down with a feather if it's just Richard going out there, making all the decisions himself and going about driving the company and where it needs to get to. I think there's most likely very intelligent people in the background that we don't hear about or see about that effectively making his vision come to reality. So notwithstanding that, yes, this is obviously going to, and it has impacted price and the trajectory of what's been occurring there in regards to sentiment, in regards to how the business operates, I actually don't think this will play a major role, as it were, in regards to its net outcome. And I think probably more fundamental aspects of the business will lead to more of direct impact on share price over the long run than the actual founder itself.
It's a pretty incredible company when you look at the growth rate of the revenue and the profit over the last, since it was listed, basically. But let's have a little close look at the business itself. And I've got this quote here from a Forbes article about Richard White where it says, from booking a ship in Antwerp through customs clearance and invoicing when a container arrives in Wagga Wagga, it's all going to be in the one system. And this is the kind of system that this company has built.
That's correct. I mean, I think there's something like they champion around 5,000 odd components within their CargoWise solution. And ultimately, yes, it's from point to point. That is what the acquisitions were all about. And that is what ultimately the software is about today, that you are able to monitor absolutely everything at every stage of the logistics chain so that you can ultimately decide where things go. And let's face it, we know that the demands for such services have been increasing. So there has been, a bit of a unique moment in time in regards to combining the success of the acquisitions through to the changing consumer behavior. And I'm going to just quickly approach the elephant in the room, because it's no surprise to anyone that this was going to eventuate and going to come. And the biggest challenge that the company has is the value score. I mean, it's expensive, right? There is no other way that you can go around it. You got to pay to play if you want to be involved with WiseTech Global. But I think it's important to note, though, that as you highlighted, that exponential revenue growth, which has come through strategically positioning itself along the entire path of the logistics chain, has obviously got analysts very excited in regards to the long-term outlook of its business. I mean, let's not forget, prior to this recent scandal and the front page reading, this company surprised on the upside when it released its annual result back in August. I mean, its share price jumped even again. And at that point, the stock was overvalued, as it were. I mean, even after the recent price decline, it trades on a forecast PE of some 70 or 80 times, actually, I should say. And even analysts upgraded their earnings estimates, their EPS estimates in most recent period, despite the fact that he's been buying houses for whatever flimsy thing on the side that's been going on. Notwithstanding, of course, he's worth billions himself personally. So that's another argument that we can have another day. But obviously, when we're talking about the company, what it's done, its whole network effect that it's tried to build in this very unique and now growing space has obviously been key to its success. And a lot of investors, as it were, have had to hold their nose in regards to jumping into WiseTech to take part of some of that long-term trajectory. Notwithstanding the recent price decline, I think you're still going to see a return to positive momentum because, of course, if you want to ship anything, you got to use CargoWise. It's as simple as that. And effectively now the software looks after everything.
Have the cost of acquisitions created any uncertainty for the business? Because a lot of the growth has been buying up smaller companies in similar spaces, hasn't it?
Yeah, and let's face it, in the ASX, these roll-up strategies have got a bit of a checkered history where they can spectacularly come crashing down as regards to paying too much for a particular acquisition, whereas I think WiseTech have been a little bit more shrewd in regards to it, whereby their acquisitions have been contributing to the ultimate underlying offering that the stock makes to the market. So notwithstanding the fact that the price may very well fall, I don't think it's going to be sustainably down on account of anything to do with headlines. Rather, it'll do with regards to the company's slowdown in regards to uptake. And to be honest, I mean, we saw something like, I think it was around 15% uptake in the most recent half year. Their forecasts for next year and the year ahead after that are also exceptional. So one would have to suggest that unless there's a marked change in the way we're going about consuming things and moving things around, that this is a company that is going to have its hands over something along that logistics chain in some shape or form, which is what WiseTech wanted to do from the very outset in 2019. But yeah, look, I think there will always come a question as to whether they paid too much for an acquisition. But I think when we're analysing this business now, we look at it from the total collective, as it were, under CargoWise, and we look at its operations and assuming that that has been integrated and adding value. And according to the business, and that's all we can really go on at the moment, they have been, notwithstanding, of course, the minor shareholders that have come on board. But to be honest, they're probably doing a better job at the moment than the major one.
It's interesting the way that this company started before even the concept of software as a service was around. I mean, it's been going actually for a long time, this CargoWise product, hasn't it?
Exactly, that's right. And the thing is that if you're a user of the software, then what happens is you just pay when you need it. So effectively, it's only when you ship something that you effectively pay that what you have to, your dues to the ferryman, pardon the pun. And that is when the revenue is actually booked. So it's very easy for a company to adopt because they know exactly where their products are in the entire process, no matter where they are in the world, no matter who they're delivering it to. And they only have to pay for it once they actually make the delivery itself. It's not like they have to have this huge overlay at the start and then try to backfill in regards to orders. So this software as a service, as you touch on, and I know that's a fancy little thing, the acronym SaaS or something like that. I mean, effectively, it's just you pay when you need. And really, that's ultimately what creates that sustainable revenue stream that so many of us analysts have been prizing. And so many companies that have historically been based on, say, contracts, as it were, whereby they take a big lick of money and then they try to make that profitable, they have been moving themselves to software as a service. And it's why WiseTech has become the largest stock in the sector, in the IT sector. It's important to remember our IT sector here in Australia is actually quite small relative to, say, the famous one we know of, which is, of course, the US. But this is the largest constituent. And yes, they have really been able to take that top position because of that revenue structure that they do have. So they control the network, they charge when they need to, and they're the two key recipes that ultimately have led to WiseTech's success, seeing them get exceptional quality scores, of course, and momentum.
And they pioneered a lot of the concepts of a SaaS kind of company, including the training aspect, because originally they were making money out of training the companies that were using it. And they realized that this was a real bottleneck to revenue and acquiring new customers. And they got rid of all of that training department, put it all online, which is basically what you see with any SaaS company now. You don't have anyone being trained in it.
No, that's right. Exactly. You effectively have this wonderful help center that you go and get whatever information you need. I mean, we can often forget that when we're educating people, Phil, that when sometimes we're talking already to the converted, they're already aware in regards to what it is they want to do. And therefore, they don't have the time to sit there and go through a big education course when they really just need that little bit of information. So it's actually meeting their clients' needs far quicker and a lot sooner, doing what they've done. And once you build that dependency, then that one person who works at ABC Incorporated then moves to DEF Incorporated. And guess what? They bring that technology with them. And then you get this network effect. So you build the reliance on the software, as this has been done again by many companies, most of them overseas, but you build that dependency. And then once that person or once a key person moves, then they bring that software with them. Because let's face it, unless they're exceptionally gifted at using spreadsheets, chances are they're going to need some assistance within their role. And you always go to the best providers. And that's really what WiseTech Global have been trying to do with regards to their acquisitions, is really create all these bolt-ons to bring into the underlying operation so that they can create this entire network that becomes so reliant that no matter who or where you are, you need to use their services. And that's been really key to their success.
Are you picking shares on gut instinct, buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB.
So let's dig into the Stockopedia numbers. What are they showing about the business? And of course, we're looking at this in the context of the recent share price decline, but then quick recovery when this latest case was settled.
Oh, yeah, that's right. And I think I then read again that there was another one somewhere else. So the chap's obviously got a problem keeping his pecker in his pants, which is absolutely amazing when I think about a billionaire like that. But I'm not even going to go there, but leave that aside. In regards to the actual numbers, in regards to WiseTech, the business itself, yes, we do obviously need to consider Richard White's holding because it is around 40-odd%. So he's still a major player in regards to this overall business. But looking at the bare numbers, the real standout to us, as I've said earlier, is the quality, notwithstanding the fact that it rates as a 95 overall. The result that they were able to deliver was actually quite exceptional in our view. I mean, when we're looking at a company that can achieve a consistent return on capital of over 15%, year on year, effectively very much unchanged, that's the sort of type of business we want to be involved with, even though I think it was possibly, it would have been around that level, and 12% then. And then not only that, the kicker at their full year result was the fact that they expect that continued earnings growth to continue. I mean, I expect they said, that sales revenue was, already at $1 billion, and I think was going to be $1.3 billion come next year. And it's easy to forget the 300 million. We can often say that as a side comment, but it's actually really quite strong. So when you're obviously a software as a service business, as you said, Phil, your margins are pretty good. So that is exactly where we want to see the company. And they're spitting cash, which obviously means that there's very low bankruptcy risk and they're pretty secure in that regard. And there's very low earnings manipulation, which means that basically what they say in regards to their profit makes its way to the bottom line in regards to the cash. And cash is king, as we know in the game, and therefore they're doing quite well in regards to that. Notwithstanding the recent price decline, its biggest challenge, as I've said, has been value. But I think I've talked about a stock even recently, another stock, Pro Medicus, where, it is definitely where angels fear to tread in regards to their share price. And guess what? I think since then their price has been continuing to go up. And they were expensive back when we talked about it, Phil. What are they now worth at the moment? I mean, definitely make your eyes water. Well, WiseTech is similar to that, notwithstanding the fact that it has had this price decline. It's still expensive relative to everyone else on the ASX. So you do have to hold your nose a bit if you are going to jump in. But then again, it is better buying now than it was, say, a month ago, which is obviously a good thing. But still, you are buying an expensive business. But then you are paying for that outstanding growth trajectory that we've talked about earlier, that network effect, the fact that you have to use their services. All those things are effectively baked into the share price and effectively are where things have gone. And this recent scandal, in our view, probably creates more headlines than it does any fundamental reason to sell down the business. So I think it could prove an opportunity for those that may have been watching. Although that said, its price today is still higher than where it was prior to its releasing its annual full-year result, which could be a second chance, last chance saloon, as it were, to get some. But that is a key point in time that I think we're going to be watching quite closely, which then takes us to momentum. And even though it's obviously underperformed the market in recent times, on a 3-month, 6-month and 1-year basis, it's actually outperformed the market being the All Ordinaries Index. So we are talking about a business which is used to outperforming the All Ordinaries Index. And I think if they're the types of stocks that you want to have in your portfolio, then an allocation to WiseTech can't be ignored because it is generating good numbers, generating strong cash, and the fact that it's going in the right direction means that it's one of those sort of one of 20 or one of 30, whatever the case may be, within your portfolio that you may hold, notwithstanding that you understand that it is a lofty price. And let's face it, the market was probably looking for a reason to sell down the stock, and these headlines probably gave it the reason. But I think that we could be putting a little bit too heavy emphasis in regards to the key person. The idea that they may very well sell down their entire holding, which is around 30%, is obviously a risk that we need to be aware of. But assuming that that doesn't occur, and this is more just regards to social pages drivers rather than financial page drivers, then that should mean that WiseTech will do well over the long run. I'm assuming it continues to deliver the quality of product that it has done to date, and it continues to expand as it has done successfully into the near term. In our view, it's a bit of an opportunity right now.
What about risk, though? I mean, apart from the key man risk that we've referred to, are there any competitors on the horizon? Anyone that sort of can get into this revenue stream?
Yeah, not at the moment. I mean, this is one of the things. It's obviously software, so anyone can compete, right? But then to build this network effect actually takes a hell of a lot of time and a big investment. And there's really no one out there that can compete on the CargoWise product. If anything, they've been successfully acquiring clients and bringing them over from those that may have been using traditional ledgers and more difficult means of recording, and actually showing them how easy it is within the CargoWise solution following these acquisitions. That's why the company was so keen to make these acquisitions and these bolt-ons so quickly, not because they thought that it would necessarily generate a greater earnings stream for the business initially, but because they could develop a total solution which becomes reliant for the entire sector to use. And we know, like if I can use the analogy of social media, you mean it's that hard to put a chat forum up there and put photos of your favorite cat or dog or whatever the case may be and have millions of people across the world see it? No, of course not. It's actually really easy to do. But to get the scale, to get that penetration, that reputation, as it were, all of that sort of thing. That takes time and that takes investment. And WiseTech Global has been doing that consistently for some time. So obviously, some might point to a global pandemic even as being a risk for this business, but actually the pandemic was good for them because everything was being shipped. That then extends to, will wars possibly be a problem in regards to disrupting the logistics chain, and we're all being more focused domestically? Well, again, that's where they were moving just from the shipping, as it were, to the total logistics chain, where ultimately you still need their services regardless of how you go about doing anything. And I think that insulates them somewhat. So if we're talking, a business moat, as it were, I actually see WiseTech as being quite large, in the sense that I don't see any immediate competitor that can just come up overnight and take the significant market share, or that has the gumption to go out and build that network that WiseTech have done over so many years. And therefore that insulates them a little bit, and the market would tend to agree with me to some degree, excluding the recent share price decline, of course. So yes, that key man risk is probably the biggest one, hence why you've seen this brutal share price reaction. But in regards to other risks, they're somewhat mitigated, part by what they do and part by the network effect that they've been able to build.
Getting back to the social pages, Elio, I love the fact that he still lives in Bexley, the suburb that he grew up in,
yes,
which is very close to where I grew up as well. And I know the history of it and the kind of lower middle class nature of that area compared to the eastern suburbs, where a lot of these legal machinations have been taking place. And apparently a lot of the lawyers were sourced from the private school parents club network as well. I don't know. I just get this feeling there's a little bit of the lower middle class versus the eastern suburbs of Sydney aspect in all of this going on that he might be relishing.
Doubt. Yeah, and that's why I'm sitting there saying that I think this is a Sydney media beat up, as it were, because it does reek a little bit of that, because I dare suggest, this was in a week where, of course, we also heard of the CEO and founder of MinRes. Chris Ellison was apparently dodging tax. I mean, a billionaire that doesn't pay all the tax that they should. I mean, blow me down with a feather. I never heard that before. I mean, it just felt like a beat up. It still feels like a beat up. And really, when I look at the underlying business, I just can't marry that beat up with regards to what it does. Notwithstanding, they could probably do with a better figurehead, and they probably will in time. I mean, let's face it, Richard's not going to live forever. No one ever does. And what he does with his money, and good luck to him. He's made a lot of wealth for a lot of shareholders over many, many years. So I am not one to begrudge him his successes and what he's been able to achieve. And as you say, the story is just wonderful if you actually spend some time and actually look at the origins and where it comes from. And it gives us hope as older fellas, as it were, that one day maybe we will get in that upper wealth region rather than necessarily social pages, Phil. But nonetheless,
good that you clarified that quickly.
Yeah, thank you. Just wanted to make that doubly sure. But in regards to the organisation, I just don't see many immediate risks, but it doesn't mean you can ever say never. And you can never say never in the share market, of course. There could be one that appears tomorrow, but at the moment, we just don't see it.
Elio, been a pleasure talking to you again today on this particular stock. Thanks very much for joining me today.
Thank you, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.